Good afternoon. I'd like to welcome everyone to the second installment in our Economic Advisory Council series. In partnership with our friends at the Global Business Alliance, we are pleased to present the chief economists of some of our shared members to talk about pressing economic issues facing the country. We are lucky to have such a wealth of knowledge and expertise within our memberships, and we want to share that with people making and shaping policy in DC and beyond. For those of you that I haven't had the pleasure to meet yet, I'm Bridget Polachine, CEO of the Institute of International Bankers. We represent the U.S. operations of nearly 90 internationally headquartered banks of varying sizes, home countries, and business models, all of which are contributing significantly to the U.S. economy at the national, state, and local level. Our mission is to help resolve the many special legislative, regulatory, tax, and compliance issues facing our members in the United States and to seek national treatment, a level playing field, if you will, so that we can fairly compete and serve clients and communities here in the U.S. The crisis in Ukraine demonstrates the need for international comity and coordination, and the IIB and its members are committed to those goals and to supporting the international response. Today, we'll have the pleasure of hearing from Tom Porcelli of RBC Capital Markets. But before we do so, I'm going to turn it over to Nancy McClernand, CEO of the GBA, to tell you all a little bit more about the council and today's events. Nancy?
Great. Thank you so much, Bridget, and welcome everyone. Appreciate you joining us. It's a busy day. My name is Nancy McClernand, and as Bridget said, I'm the president and CEO of the Global Business Alliance. We're really excited to be hosting the second session of the Economic Advisory Council with IIB, and glad that you all are here to join us. Before I go over our agenda and introduce our speaker, just a quick word about the Global Business Alliance. GBA is a trade association based in Washington, D.C., and we represent approximately 200 international companies doing business in the United States. Our member companies operate across a very wide spectrum of the U.S. economy, including manufacturing, retail, and of course, as Bridget mentioned, the financial sector. Our members come from countries that are longtime allies and friends of the United States. I think our members come from 22 different countries, so lots of places all around the world, but from our friends and allies. We advocate for policies to help ensure that the United States remains the most competitive location around the world for foreign direct investment, which in turn increases American employment, U.S. economic growth, and a lot of growth specifically in the manufacturing sector. A whopping 69% of all new U.S. manufacturing jobs were created by international companies over the last 5 years. So counterintuitive to some, foreign direct investment is literally embodying made in America. And it definitely is a stat that I think really highlights the importance of remaining competitive for cross-border investment. So today we're going to explore potential Federal Reserve actions to alleviate inflationary pressure. And, we put this together all before the Ukraine crisis really kicked into high gear over the last 24 hours. So I'm sure that we'll get to that. And specifically, we also want to talk about how these inflationary pressures, the Federal Reserve actions, will impact the midterm election. So we hope that everyone will get ready to ask some questions after Tom gives some opening remarks. So now it's my pleasure to introduce Tom Porcelli. He is the Managing Director and Chief U.S. Economist at RBC Capital Markets. His work focuses on piecing together the U.S. economic backdrop as part of the global economic effort. Prior to joining RBC, he worked as an economist at Merrill Lynch, where he was a member of the team responsible for economic forecasting and Fed watching. At the onset of his career, Tom worked at the Federal Reserve Bank of New York, and he was closely involved with the execution of monetary policy. Tom is regularly on CNBC. We just saw him there yesterday, and Bloomberg. He's widely quoted in the global press and is a fantastic at making very dense macroeconomic information accessible for those of us that want to know some top line information. So Tom, thank you so much for being here, and I will go ahead and turn it over to you. Oop, Tom, you're muted.
Here you go. Sorry, yeah. I've been doing it for 22 months. You think I'd know to take myself off mute. Sorry. So thanks for having me. I really appreciate it. And, what a day to do this. I don't know. There's obviously no shortage of things to talk about as it relates to inflation. But I think, I think I would be foolish to not make some comments about what's happening here today with Russia, because obviously we'll have some implications for potentially some implications for inflation in the United States in particular. So let me start. Let me start with that first. Look, I think that when I think about the sort of the state of things in the United States, I think what we need to be mindful of is, the way that what could potentially happen with Russia, Ukraine, the way that could potentially feed through into the U.S. I mean, there's an assortment of ways that it could, but I think one of the more immediate aspects of that is significant effects could be through the inflation channels. I think if you just look at crude oil, I mean, if I'm looking away, I'm looking at all my pricing screens up. Crude is obviously up pretty significantly today. That's been the case now for the last 2 months, right? I mean, since tensions really started between Russia and Ukraine, basically back in December, and crude prices have done nothing but rise since. And so, one of the classic sort of feed through channels for events like this, particularly when energy producer is involved, is to see it come through at the pump, right? Because at the end of the day, I think just to make hopefully a really basic point, people don't buy barrels of crude; they buy gallons of gasoline, and so that's an important idea because when you think about inflation, that's what shows up in inflation, right? It's what's happening at the pump. And so here's what we need to be mindful of. Right now, a disproportionate share of people's disposable income is being sucked up by rent, by food, and by gasoline, right? The basics. And when that's the reality, then that doesn't leave much left for non-energy consumption, right? That's the reality of, when you think about energy shocks of the past, that is the reality of these energy shocks. I mean, it actually does have an impact from a consumption perspective. And when I think about that in the context of where we are from a consumer perspective, look, the consumer, so there's countless ways of looking at sort of consumer dynamics. And so one of them is, one of the things that we sort of championed early on in the pandemic was looking at something called excess saving. I think there's an even better way of looking at it, and that's to look at liquid assets. So consumer liquid assets. So how are we defining that? Liquid assets are literally things like checking accounts and savings accounts and things like that. And the good thing about looking at that breakdown is we can look at it by income quintile. And so what we can observe is, per the most recent data, the fourth and fifth income quintiles. So the sort of the lower income quintiles, the fourth and fifth quintiles, they have, if you look at the change today compared to where we were pre-pandemic, they're now below, the fourth and fifth income quintiles are now, from a liquid assets perspective, are now below where we would have been had the pandemic not happened. Think about that for a second, right? So in other words, if I just create a baseline of, hey, the pandemic didn't happen, this is what liquid assets would look like, where they are today is actually lower, right? There's been a tremendous amount of overspend that has taken place really across the board, and especially in the lower income quintiles. The third income quintile, they're in slightly better shape, but even they've used quite a bit of these extra liquid assets. And then the first and second quintile, they're still sitting on quite a bit. But like the reality is, their marginal propensity to consume is not nearly as high as the lower income quintiles. And so that's an important idea as it relates to spending. I mean, look, we had 6% growth last year, right? 6% GDP last year. The only way to get to that is for an enormous amount of spending to take place. And we saw that. What we think is going to wind up happening this year is that growth is going to slow down, in large part because of that dynamic that I just mentioned. That a lot of the lower income quintiles have really used up a lot of this excess liquidity. And so I just make sure we're all on the same page. I sometimes I take certain things for granted. Where did all the excess sort of liquidity come from? Well, obviously it came from fiscal stimulus, and assuming that we're not going to see any additional fiscal stimulus, which I'm sure there are people that are listening on here that have better sense for that than me. But my sense is that it's going to be unlikely that we see any dedicated stimulus to the consumer. That means that growth is going to slow this year. So why again, I think it's important to sort of flesh out all these ideas so you understand where we're going from an inflation perspective. Because yes, inflation started out as a sort of supply issue, related to the port issues and et cetera. But it evolved from there. I mean, that's what that was the catalyst. But it was demand that really drove inflation higher as the year progressed. Well, the consumer is now not in the same position financially that they were last year. And so I think it's really easy for us to make the case that inflation, core inflation specifically, and I'll come back to that idea in a moment, core inflation will wind up slowing down as the year progresses. I know that might seem hard to sort of, believe or hard to get our heads around. But just keep in mind, last year at this time, guess what I was talking about? I was talking about how inflation was going to be much, much firmer than everyone thought. And I was alone on an island on that call. And I feel very alone on an island again when I say, hey, inflation is going to be a lot lower by the end of this year. Just so you know who the messenger is on this. I'm very willing to change my view as necessary. My view on inflation, it's a high conviction call. And so why do we think that inflation slows down again, core inflation? And so let me digress for a moment. Why do I keep on stressing core inflation? Because I have no idea how to forecast headline inflation. And let me be clear, no one does, right? I mean, headline inflation is at the mercy of energy prices. And I know some pretty great energy analysts and strategists out there, and they have a hard time forecasting energy prices. So, and moreover, it's not like the Fed can do anything about energy prices. This is not part of their mandate. They exist within their bag of tricks include blunt tools that have no ability to impact energy prices. So when I think about inflation, I almost always think about it in terms of core. And core inflation, we feel confident saying that that will slow as the year progresses. So let's walk through the anatomy of that and why. So I gave you the basis for sort of this or the starting point for this conversation. There's going to be a lot less demand this year, as a result of using up a lot of these liquid assets. Here's another idea to keep in mind. The thing that really did a lot of the driving from an inflation perspective, it was really a function of goods prices. Goods prices in the United States for the last 20 or 25 years have been in a sort of a perpetual state of disinflation. That makes a lot of sense when you consider, look, we import a lot of goods. And if you import a lot of goods from low-cost producers, you're able to sort of import some element of disinflation. And that's what we have done for the last 20, 25 years. And the data on goods prices are a reflection of that. You can look at it in the CPI report and see that goods prices have really been more in a state of slowing than they have been in a state of acceleration, except for now, right? Except for, in the pandemic window. Consumer spending really shifted in a very profound way. We became a nation of spenders on goods as opposed to services. We classically spend a disproportionate share of our income on services. We didn't during the pandemic for all of the obvious reasons, right? People were loading up on paper towels and cleaning stuff, and things to enhance their houses, and et cetera, because the service economy was mostly shut down. But there's going to be a transition that occurs this year. And we think the transition will be back to sort of the way that it was, which is to say more spending on services than goods. So as that transition occurs, as the shift occurs, you'll start to see goods prices really start the process of slowing down. And we think that transition, again, this is all assuming things don't get worse with Russia, which again, I don't know how you handicap that. I think that there's I've spoken with quite a number of geopolitical strategists over the course of the last several days, and today in particular, and I have heard some scenarios that sound extreme on the face of it, but when they explain it, it sounds like some of these possibilities are real. So again, I fully acknowledge that that's something that we need to be mindful of. But if and it's a big if. But if this geopolitical scenario calms to some extent eventually, I think that this transition away from goods to services will almost certainly take place. And as a result, I think that goods prices will actually go back to the state in which they almost always existed, which is to say, state of disinflation. And I think that occurs over the course of the year. Here's the other thing to keep in mind, particularly as it relates to that notion, and why you would expect goods prices to slow. I think everyone's so focused on the ports. I think, and I think they're focused on the wrong thing. I don't necessarily congestion in and of itself is not necessarily something that I would worry about in any dramatic way when you consider that there's a mountain of inventory right now. I mean, it's like the ports have shaded people from the reality of, but even with all the port congestion, we're still getting in a lot of stuff. And so if you look at retail inventories right now, retail inventories in the United States are about 50% higher ex-autos than where we were pre-COVID. So if this transition from goods to services happens, and you have you're sitting on a mountain of inventory, what do you think is going to happen to goods prices? I mean, they're going to slow, and they're probably going to slow pretty dramatically, I think, relative to what a lot of people expect. So what is the net result of all of that? The net result is, I think by the end of the year, I think you're looking at core inflation that's probably around 3%, which, look, right now we're looking at core inflation that's around 6%. I think we're going to get another inflation report in the next 2 or 3 weeks, if I'm looking at my calendar right. And I think with that number, you'll get it'll probably bounce up to around 6.5%. Core inflation will. Headline inflation will drift even higher than the 7.5% that it's at right now. But I think by the end of the year, you're looking at around 3% core inflation. That's a wild difference compared to where we are today. And so what does all that mean for the Fed? I mean, look, I've been saying for a while now, even in the face of, a lot of forecasters that are looking for, 7 hikes or 8 hikes, well, I guess 7 hikes this year. I love that Jay Powell keeps on saying that, they're trying to be, they want humility and they want to be humble about this. And that's all well and fine. But I think humble and humility is what they needed last year when they were pushing the wrong narrative on inflation. What they need this year is a mountain of patience. And what I mean on that is, if they just give this time, they'll start to see that, again, core inflation will start the process of slowing to some extent. Again, the caveat, of course, is Russia. I'm going to keep on coming back to that because I know people like to latch on to single ideas, but it's a multi-faceted idea. And so if that's right, if our view is right, then there will be no need for the Fed to get very aggressive here. And look, in fairness, again, with I think Russia now, very much in the forefront, given what happened last night, the market has already removed a 50 basis point hike. That's now gone. I think, even just looking at sort of Fed funds futures, it looks like the market is even starting to price out some of the extreme hiking cycle that a lot of folks have been talking about this year. It's still nascent at this point. I think the market is now looking for it's just below 6 hikes between now and the end of the year. I think that will probably continue to sort of come back toward what my view is, which again is to say 4 hikes this year. But I think in the context, I kept on saying to people, I think time would help. Time would be the Fed's friend. What I mean by that is, we're coming up to a point here where base effects alone, right, like easy year ago comps, are going to start to enter the equation, which is to say you had really strong month-on-month gains in inflation, in sort of March, April, May, and June of last year. We're not looking at the same kind of prints this go around. So at a minimum, favorable year ago comps are going to start eating into the year-on-year run rate. If you throw in my idea of the shift away from goods to services spending, I think that will also that will just sort of add even more downward pressure. And so I think by the end of the year we could be in a really much better spot, which will, from an inflation perspective, which I think will take a lot of the pressure off of the Fed so that they can avoid getting too aggressive here. So there's so much more to say, and I tried to weave in as much. This, we would have been having I think a very different conversation if Russia didn't do what they did last night. It's a wild card on the inflation idea, but it's these are markets, and we take all of these inputs and we try to figure out what it means. But why don't I stop there? I don't know who I'm handing it back off to, Bridget or Nancy, but why don't I stop there and see if there are any questions?
Yeah, definitely going to be questions. Thank you so much, Tom. So I've already got a question from the audience. And so for those of you who are joining us, please go ahead and put your questions in the chat, and I will read them out to Tom. So the question is, so if I'm hearing you correctly, there's a real concern that the Fed action might lead to an overcorrection. What would that mean for employment rates and economic growth?
Yeah. So, look, I think that I think here's an interesting thing to think about. I think about my parents, my mother and father. My mom's actually here today helping with the kids, and she has her son is the chief economist for a pretty big bank, and yet when she gets her inflation information, she doesn't get it from me. She gets it from whatever she's reading online, right? I don't know. She has access to me. I wish she would use me a little bit more in that regard, but she doesn't, and so that's fine. But she's very representative of Main Street, I think. I think Main Street sort of gets their information from whatever they're reading. And so if you have all of these sort of challenges in place, right? The sort of lower income quintile consumer has used up a lot of this liquid assets. You're looking at probably slowing, and I didn't mention this. I don't think I mentioned this. You're looking at slower wage gains this year because, again, if your economy is, when an economy is running at a 6% pace, you need 11 million job openings. When an economy is running at a 3.5% pace, which is what I think it's going to be this year, you don't need 11 million job openings. And there's a very symbiotic relationship between job openings and wages. In fact, job openings tend to lead wage pressure. So if openings are going to slow, so too are wage pressures. So you start to add all this stuff up. It's low-end consumer has eaten into most of those liquid assets. You're now looking at probably slower wage gains this year. Energy prices are incredibly elevated. They're paying a lot more for all of that sort of basic stuff, right? The food, the energy, the rent. And then you want to layer in on top of that an aggressive Fed. How's that going to be received by the consumer? And so, because again, think about how people like my mother are going to receive it. It's going to be plastered over whatever website they read. Fed aggressively raising rates and et cetera, et cetera. Mortgage rates rise, credit card payments rise, et cetera. So I think that it's more of a sentiment idea. I think you need to be mindful of the sort of the fragile state of a consumer that is now growing, I think, probably painfully aware that, hey, we used up a lot of what we had, and wage pressures are now slowing down. I think that's something that, it's funny. I think about that, by the way, in the context of, I keep on talking about the lower income quintiles. Think about the upper income quintiles. look, wealth effects are a very fuzzy concept. I've done a lot of work on them. It's very hard empirically to sort of prove that they really do work, except for in the extremes. Well, look at the equity market over the course of the last year and a half. I think that that's an extreme. I mean, the equity market was ripping over the course of, the sort of the entire downturn. And now all of a sudden we're down, looking at my screen, we're down 12% year to date on the S&P. And from the peak, it would be down probably then 14% or so. How's the upper income then feeling about this now too? There's again, if negative wealth effects work in the extreme, and we can maybe safely say that this is an extreme, I think that you can have a negative wealth effect in place right now. So you have lower income consumer that's reeling from all the things that I've mentioned a couple of times now. And now you have the upper income consumer that's going to be reeling on the back of a potentially negative wealth effect. I mean, you can have a backdrop that feels pretty recessionary. And again, I want to be clear. I'm not saying you are going to have a recession. I'm saying that you can get this sort of stutter step where, sort of things slow down, like everyone just goes into a state of pause. And you could feel like a sort of a more meaningful slowdown. I mean, I think at the end of the day, I think what's happened with all of these factors, and then now pile Russia on top of that, I think an extreme Fed is almost certainly not going to happen at this point. I think it would be an utterly foolish thing, and that's stating it politely, for them to go down that path. So, but that would be the risk, right? The risk, if they do it, if they do get aggressive, is exactly what I've just highlighted. There's already a mountain of risks out there, and that would just, I think, sort of teeter us over into a very sluggish backdrop, even if it's not necessarily recessionary.
Tom, you're talking about how individuals are perceiving and reacting. What about some of your corporate clients, right? How do you see them responding in terms of investments here in the United States? And, how, because obviously that's a key factor in terms of how we're going to go through the rest of the year.
Yeah, I think that companies are, I speak with quite a number of corporations on a regular basis, just as part of my job. It's one of the things I love about being an economist. I get to speak with an assortment of different clients, and on the corporate side, and when I say corporate side, I mean sort of non-investment related corporate entities. So companies that sort of make stuff and build stuff and sell stuff to retail consumers. One of the things that has become very clear to me is this desire to defend margin. With wage pressures so incredibly elevated over the course of the last year, with companies having a really hard time finding workers, I think that this is giving companies real incentive to go down the CapEx path to try to enhance productivity. That's a reality. And it's everywhere. If people would just listen, it's everywhere. For companies have been talking about it pretty regularly. So I think that to me has been one of the very interesting things about what's come out of this dynamic of COVID and incredible wage pressures and really having a hard time finding workers. It's really forced companies to sort of rethink, hey, how are we supposed to be spending our CapEx dollars? And I think a lot of them, and again, it's I would call this still sort of nascent to some extent, but I think a lot of them are going to go down the path of trying to enhance productivity to try to defend margin.
Yeah, that makes complete sense to me. Okay, we got a couple other questions now. First, when would you expect to see the inflationary pressure start to ease? Which quarter? Summer, fall? And what will be some of the first indications, the indicators you'll be watching?
So, again, I hate to keep on saying this, and again, this is why it's a tough day to have this kind of conversations. We're in such a hopefully everyone appreciates this. We're in an incredibly fluid backdrop right now. I mean, a lot of this stuff is going to wind up changing, just given what's happening with Russia, Ukraine. But our baseline view had been that you would start to see some real slowing in inflation starting in April. Well, let me be clear. For the data, for April data, which actually wouldn't get reported until May, you'll start to see some, I think, real slowing then. Again, that's when this idea of base effects really kicks in. And again, assuming that, Russia, Ukraine don't escalate further from here, I think that transition from goods to services, I think certainly would happen roughly around the same time, call it around the middle of the year. And I think that sort of lends even more sort of downward pressure to the idea that inflation does start the process of slowing in a more meaningful way. But again, I want to make sure everyone understands this. And look, we're in February, and I know particularly for a lot of investors, I think a lot of people view December as sort of the finish line. It's not the finish line, particularly as it relates to inflation, because I think as I think about 23, I want to be clear. While I do expect inflation will slow down quite a bit this year, I also expect that inflation can remain very elevated relative to the Fed's target. Right, the Fed's target is 2% inflation. I expect that you're somewhere between 2.5% and 3%, even into 23. And so if the Fed goes at this in a slow way, which is what I think they're supposed to do, as I said, I think that they would still remain engaged even in 23, because inflation would still be north enough of target for them to continue the process of removing accommodation. I think that's a really important idea that had been pretty underappreciated.
What role do you think fiscal policy should play in any deflationary action?
I think you look, and I know I'm sure there's some policymakers or people that speak to policymakers on this call, and someone else says, "I'll tell you what I really think. Just call me offline, and I'll tell you what I really think." But look, I think what we need to be mindful of is part of the reason why we have this level of inflation is because people had the means to be able to drive inflation. That's a reality. I mean, I don't think that's certainly not a debatable point. I think we can have a reasonable discussion about the degree to which the consumer should have continued to be the beneficiary of fiscal stimulus. I think that's a totally reasonable discussion point. But I don't think there's any debate about the idea that a lot of the fiscal stimulus that we put in place fed inflation. That's a mathematical reality. I mean, whether people want to embrace that or not that's for you to decide. But that's a reality. Again, it started off with supply chain, no question, supply issues, but it evolved into pure demand. And that's why we are where we are. But again, it's all going to work in reverse. Demand works both ways, right? It drove inflation higher, but now it's going to work in reverse, and it's going to drive inflation lower because there's going to be less of it this year. Mostly because the consumer is sitting on a lot less means to be able to drive that. So I think that is, I'm guessing that's what most people are asking or thinking when they ask that question about fiscal. I would say, look, if you want to really sort of another sort of channel to go down, or another path to go down on that discussion is, look, if fiscal policy can be tuned to help engage productivity, that's a brilliant way of trying to get a handle on inflation. But I don't hear a lot about that coming out of DC, for better or for worse. But that would be certainly another path. Incentivize productivity. That's always a great way of getting a handle on inflation.
Do you expect a cycle of wage price spiral inflation? Do you expect a cycle of a wage price spiral inflation to persist?
Yeah. So I think the short answer is no. And a lot of that is, and again, this was even pre-Russia. Again, I think Russia probably exacerbates some of this. But even before last night, I think the one thing to be mindful of is, look, if it's true, as the data highlight, that you have the lower income quintiles are now sitting on less liquid assets. Again, cash, checking, savings, etc. I think what that does is I think that incentivizes people to come back into the labor force. And so I don't think I wouldn't doubt for a second that you do see more of an influx into the labor force. And when that dynamic happens, then companies are not incentivized to continue raising wages to the degree that they have. And as I said earlier, if things are slowing down from a growth perspective, that means job openings are going to slow down, and as a result, that means wage pressures will also slow. So no, I don't think we're going down that path. But again, I do think that we need to be mindful that even with the slowing, I still think that wage pressures will remain elevated. I mean, I think you'll still remain, more elevated relative to where we were pre-pandemic. But that's not the stuff that a wage price spiral is built around.
Okay, how does the Fed's purchase of large-scale assets inflation?
Yeah, so I'm going to try to avoid the weeds on this conversation as much as I can. But for better or for worse, this is this conversation is slightly technical. I'll try to keep it very simple. So
Right.
QE, right? Quantitative easing. Quantitative easing, the amount of duration that's being removed from the market because the Fed specifically tells you, hey, we're buying a bunch of 10-year treasuries. We're buying a bunch of 7-year treasuries. So you could do the math on saying, hey, this is removing X duration. We know that number is very knowable. QE, that's QE. QT, right? Quantitative tightening, which is what the Fed is going to embark on in the immediate term. QT is not the mirror image of QE. So why? The reason for that is because for the most part, when the Fed is selling assets or letting assets roll off, when the Fed is letting assets roll off, they create a funding gap between themselves and the Treasury Department. And it's the Treasury that decides how the funding gap is going to be met. And what we think is going to wind up happening is that they're going to wind up meeting with bills, Treasury bills. Now, if that's true, then there's no duration add back into the market. So in other words, QT will not be worth any number of hikes, right? Like, you can make the argument QE is worth, hey, it's worth a hike or two, depending what the duration removal from the market is, but QT doesn't work that way. I think it's a really important sort of base conversation. I just want to make sure everyone is sort of very clear on that. And if it's not, shoot me a message or reach out to me after, and I'll get in touch with you. But that's the basis for the conversation. Now, I think what we need to be mindful of, again, in that context, I know a lot of people are saying to themselves, well, look, M2 is up, right? This is people, it's funny. One day I should become a professor so I can rewrite some of these economic books because they're still teaching this stuff, which is appalling to me. But anyway, M2 does not work the way that people think. And so what people and so I can easily pull it up. In fact, I was just talking about this. And so here you go. So people will say, well, look, M2 is up, and that's inflationary. Because of all the QE that the Fed did, you have this this inflation in the making. That's utterly ridiculous. That's not how it works, right? So M2, like the way you have to think of it is all this stuff winds up showing up in deposits, right? Deposits at banks. Now, the only way that becomes inflationary, all of these reserves that are being created that are now sitting at deposit with the banks because of QE, the only way that becomes inflationary is if banks lend it out. And so, again, I don't know. I try to keep things simple, which is probably why I was asked to be on this call. Just prove this to yourself, right? Don't listen to the crazy economists. Just go and go to the Fred website, the St. Louis Fed website. Fred, it's called, and you can pull this stuff up and you can see for yourself. If you overlay M2 on actual lending, right, in the banks, and we have all this data, right? The Fed produces all of this data. The board does. Yes, M2 is up dramatically, or deposits. It doesn't matter. They're both the same thing. You can look at it the same way. Guess what lending has done, right? All the while you have these deposits in M2 that are up wildly. But loans haven't done anything. Lending hasn't done anything. It's literally moving sideways. So the notion that QE is the thing that created all this inflation, that's ridiculous. And I don't know, but people hear what they want, I guess, or whatever suits their agenda. But that's the math. I'm a mathematician at the end of the day. I don't care what anyone's political leanings are. It doesn't make a difference in the world to me. You're just getting the math from me, and the math on this stuff is pretty clear.
Mm-hmm, mm-hmm. So how does the growth of the Fed's balance sheet impact inflation?
It doesn't. If there's no transmission from all of the reserves that are being created and thus all the deposits that are being created, and there's no lending that takes place, You don't have any of the classic inflation. What you could have is asset inflation. There's no doubt about that. I think that's totally fair. But that's obviously a completely different kind of inflation, right? Where we're not talking about consumer inflation there. I mean, that's something that's a wildly different animal. But I think you can definitely draw a corollary to ultra easy accommodation and asset inflation. That's sure. But that's not the kind of inflation I think people are asking about.
Right.
But it's
Okay.
real. It's not any less real. It's just, I think it's just a different question.
Okay, I've got one more question. Oh, I've got two more questions now in the queue. We promised you, Tom, that we'd end at 2:50. We know that your day is quite busy, so let's get to these two before you ring off. How correlated is U.S. inflationary pressure to other nations? One would expect the Ukraine invasion to Europe's breadbasket is problematic for European economies. Beyond any first-degree impacts on the U.S. economy, should we expect secondary impacts from European pressure?
Yeah, it's entirely I mean, look, we're all interrelated, right? That's just that's the nature of our global economy.
Right.
You can't
And really what we're here
disentangle
today to talk about, between the Global Business Alliance and IIB, right? That's exactly what we're talking about.
Yeah, that's exactly right. And so we are very we are not a goods producing nation, right? I mean, we produce quite a bit of stuff, but we import a mountain of goods. And so I think we need to be mindful of the inputs. Russia is responsible for quite a number of inputs. I think I'm sure a lot of people on this call appreciate palladium. That's a massive. Russia is a massive producer of that, and that obviously gets fed into cars. It's used in catalytic converters. I'm certainly no commodity expert, but I sort of know enough to know that there are certainly channels through which this will show up. The most obvious and the most immediate would be on food, and it would be on energy. That's where this is going to show up. But do not discount for a moment that there are all these other channels that I think a lot of people aren't aware of, like the palladium catalytic converter thing, in a sector, i.e., autos, that's already completely on fire from a price perspective.
Right.
Used car prices, I think, is widely appreciated, is they're through the roof, and literally, it's madness to me that people are actually even buying used cars right now, given the prices that are there. But I guess if you need it, you need it. So yeah, look, it's hard to game out. It's something that we're aware of. I mean, I think in a lot of ways, when things like this happen, you become very reactionary. So we'll react to it depending how this unfolds. And again, I've spoken with quite a number of I think very, very good geopolitical strategists over the course of just even the last few hours. That they're having a hard time gaming this out themselves.
Sure.
So we'll see is the short answer. I mean, I hate to give I like to give direct answers, but unfortunately, there is no direct answer. The right way of thinking about this is we'll see. Depending how the degree to which this becomes something more than what it is right now. But yeah, there's no question that channel could impact us.
Yeah. Okay. Final question is: do you think the price of gas, food, consumer goods, etc., and supply chain disruptions will still be front page news around Labor Day?
The short answer is no, I don't. But I'm happy to talk about some of the quick risks around that. So one of the risks is, look, I think one of the things that we need to be mindful of is COVID still. I mean, I know Russia is obviously going to dominate right now. But I think, we take a step back, just recognize COVID has an impact at the ports. We could see that. Like we've showed sort of the correlation between COVID case counts and port activity. When COVID case counts are dramatically on the rise, port activity slows down. That's that's a mathematical identity. So we need to be mindful of that. But look, I think we are. There's, I think, a lot of evidence to suggest that we're now in the endemic phase of COVID, or at least I think we certainly will hope that we are. And so hopefully that will not be an issue going forward. But again, we need to be mindful of that. The other thing, of course, is this idea that Russia and Ukraine, this could linger. Who knows how long this goes on for? And if it lingers for long enough, then you will actually have continued demand for goods. This would sort of really lend itself to more goods-orientated kind of spending. Again, I want to be clear, in an escalation, right? An escalation relative to where we are today. If it doesn't escalate from here, I think by the time we get to Labor Day, I think that port issues, supply chains are completely behind us. But if we get some escalation in Russia, Ukraine from here, it's entirely possible that it's still a challenge, because that means that demand for goods will remain very, very buoyant.
Well, great. Tom, I learned a lot, and really appreciate your time this morning. I hope your mom will start asking you questions and not just on what she's reading online. But this has been terrific. If anyone has any follow-up questions you'd like us to send to Tom, happy to do that. Reach out to GBA, and I'm sure IIB as well. So with that, Tom, I think we're done. Thank you so much.